Introduction: The Trap of Passive Investing. Everyone tells you the same advice. Just buy Apple, hold it forever, and you will get rich. It sounds simple, right? But they never talk about the pain. They don't tell you about the months where your portfolio drops by 20 or 30%. They don't talk about the panic that makes you sell at the very bottom. Passive investing is easy when the line goes up, but when the market crashes, emotions take over. That is why most retail traders lose money, not because they pick the wrong stocks, but because they can't handle the volatility. Today, I want to show you a different way. A way to trade based on pure mathematics, removing all human emotion from the equation. I wrote a Python algorithm to trade Apple stock using one of the oldest indicators in history, the Relative Strength Index, or RSI. My goal was simple. Can a few lines of code beat the buy and hold strategy over the last 3 years? I ran the test, and the results. Well, they taught me a massive lesson about risk that I'm going to share with you. 130. The strategy. Why RSI? Before we look at the code, we need to understand the weapon we are using. The RSI was developed by J. Wells Wilder back in 1978. It measures the speed and change of price movements. Think of the market like a rubber band. If you stretch it too far in one direction, panic selling, it eventually has to snap back. That is called mean reversion. My algorithm is designed to exploit this specific behavior. It follows 2 strict rules. Rule number 1, we buy when the RSI drops below 30. This is the fear zone. When everyone else is selling Apple because they think the company is dying, our bot sees a mathematical opportunity. It steps in and buys the dip. Rule number 2, we sell when the RSI goes above 70. This is the greed zone. When the price is skyrocketing and everyone is euphoric, the bot secures the profit and moves to cash. It sounds simple, but as you are about to see, executing this in the real world is terrifying. 3 on to cause. The execution. Walking through the trades. Let's look at the actual performance log generated by my Python script. We are testing this on Apple, ticker AAPL, starting from 2023. Notice the start of the simulation. For months, the bot does absolutely nothing. This is the hardest part of algorithmic trading. Patience. The market was moving sideways, but it never hit our extreme entry criteria. A human trader would have gotten bored and forced to trade. The code just waited. Then, look at October 26, 2023. Apple drops to $165. The market sentiment was negative, but the math said, buy. The bot executed its first trade. Just 2 weeks later, on November 10th, it sold at $184. That is a quick, clean profit while the market was still deciding its direction. Throughout 2024, we see a cluster of trades. January, February, May. Notice something interesting here? The bot is not catching the entire trend. It is taking bites out of the market. It buys the dip, waits for the bounce, and gets out. It is not trying to be a hero. It is trying to be a sniper. 5 on dog. The perfect trade. And the volatility. I want to highlight one specific sequence that happened in 2025. Look at the log for April 2025. On April 7th, Apple crashed to $180. The bot triggered a buy order. This was likely a scary moment for human investors, a sharp correction. But look what happened next. The price rallied hard. By April 29th, less than a month later, Apple hit $210. The RSI overheated, crossed 70, and the bot sold everything. That single trade captured a massive move. And the best part? When the price inevitably corrected after that peak, we were already out. We were sitting in cash, safe and sound. This is the beauty of this strategy. It minimizes your time in the market. You are only exposed to risk when the odds are mathematically in your favor. However, it wasn't all perfect. Look at the period between late 2023 and early 2024. The bot missed a significant portion of the rally. Why? Because the price went up slowly and steadily. The RSI never dropped below 30 to give us an entry signal. We were left watching the train leave the station. This is the cost of being conservative. 6:30. The results. Bot versus human. Now let's look at the final scoreboard. The data doesn't lie. First, let's look at the benchmark, the buy and hold strategy. If you had bought Apple in 2023 and just held it until November 2025, your return would be 58.45%. That is an impressive number. Now look at our RSI bot. The total return is 55.73%. So at first glance, you might say the experiment failed. The bot underperformed the market by roughly 3%. A simple hold strategy made more money. But wait, profit is only one half of the equation. If you stop the video here, you miss the most important lesson of professional trading. We need to talk about risk. The hidden metric, drawdown. In the trading world, we have a metric called max drawdown. It measures the worst pain you would have felt during the period. It answers the question, how much money did I lose at the worst possible moment? Look at the buy and hold strategy. The max drawdown was 33.36%. Imagine you invested $10,000. At one point, you were down to $6,600. You lost a third of your money. Be honest with yourself. Would you have held? Or would you have panic sold at the bottom, locking in that loss? Most people sell. That 58% profit is theoretical. Most people never actually get it because they quit during the crash. Now look at the RSI Bot. Its max drawdown was only 11.47%. It never crashed. It never destroyed your account. While buy and hold investors were having heart attacks, this algorithm kept your capital relatively stable. Conclusion: risk-adjusted returns. So here is the verdict. We paid a small price, about 3% of potential profit, in exchange for massive safety. We reduced the risk by 3 times. The bot executed 8 trades. It won 6 of them. That is a 75% win rate. This experiment proves that you don't need complex neural networks or supercomputers to trade effectively. A simple, disciplined strategy that manages risk can perform almost as well as the market, but with significantly less stress. For a volatile asset like Apple, this RSI strategy is a winner in my book. Not because it made the most money, but because it made good money safely. In the next video, I want to push this further. I want to see if we can beat the market and keep the safety. I will be adding a trend filter to this code to fix the missed opportunities we saw earlier. Make sure you are subscribed to see that code. Class dismissed.